But when a crisis hits, the world pretty much turns into that old story of Chicken Little. Everyone's running around screaming, "The sky is falling!" And that creates this incredibly dangerous feedback loop. Fear makes more people sell, which makes prices drop, which creates even more fear. And today, you've got computer algorithms that are programmed to sell automatically, which just throws gasoline on the fire.
But that brings us to one last really important thought here. All of that fear, all of that panic selling, what does it do? It pushes prices way, way down, often way below what things are actually worth. So what if? What if the absolute worst time to be in the market is actually the best time to be investing?
So if we look at all the data we've talked about, a pattern starts to emerge. War is absolutely devastating for an economy that's on the front lines. But for a market like the US that's far from the fighting, the financial panic is often over surprisingly fast. And that leaves us with a really big question to think about. As an investor, what's the real enemy here? Is it the war itself, or is it our own fear and the panic of everyone else around us? Because what the data really seems to suggest is that more often than not, the biggest risk you can take is listening to Chicken Little.